Yo, what's good guys? It's Solar Banks. So in this video, we learn how to catch trades like this with precise entries and exits, basically using liquidity sweep and Fibonacci retracement. This is the only trade that took last week, by the way. It's a 5-hour setup, you feel me, and I actually held this trade. And you see, this is when it was actually running. Yeah. Liquidity is simply the extreme or swing highs or lows where money is sitting at. You feel me? It is as simple as that. For example, let's say the market is buying, the market is in an uptrend, the market is creating a higher high, a higher low, higher high, higher low, higher high, and you see something like this. All these levels here, around here, are what we call, all this level right here, let me use this. All this level right here are what we call I will call swing point, swing blue. This is a swing blue now because it is coming from down, it's coming from down to up here. So this is one, this is another one. Let me use this. This is another one, and all these points here, this is what we call swing lows or swing highs. You see this particular one, this is a liquidity right here. Where retail stop loss is sitting at. Because take for an example, why am I choosing this particular piece? Let's say if a retail trader is going to take this particular trade, how are they going to enter? They will probably see this as first leg and this as the second and this as the second leg, and this as the second leg. So, and if they see this as the second leg, they'll wait for something like candle confirmation, of which they'll then buy from here and put their stop loss around this place and be anticipating anything from about 1:2 or whatever. You feel me? This low, I want to delete this place. You see where their stop loss is sitting at. This low, they believe that price is not supposed to come back to that particular place. So where their stop loss is sitting at, God. So where their stop loss is sitting at here, it is a potential liquidity level. We are not saying every time the market is stop them out, no. But where they are putting their stop loss, anywhere, not even them alone, wherever you put your stop loss is a potential liquidity level or potential liquidity zone. You feel me? So this is a liquidity. This is a liquidity right here. Wherever you see the sign like this, it means money is sitting down there. So if price should come there, this particular price, and do something like this, if price should do something like this and buy from here, that means that's what we mean by market has grabbed the liquidity around there. You feel me? Let's delete this. For it to make sense. Once the market grabs the liquidity here, we'll be anticipating price to mitigate any potential demand level here and buy straight any potential demand level or discounted level. You feel me? So we are still going to the Fibonacci retracement. You feel me? So don't worry about what we call discounted level or demand level. You feel me? So once the market mitigates the demand level or demand zone here, we're anticipating the market to buy. But at first, the market has grabbed their stop loss. So that stop loss that the market grab is what we call liquidity, and that's where we want to enter from, something like this. If the market has not grabbed liquidity, we don't want to enter. It is as simple as that. So that's that about liquidity grab. You feel me? So now let's go to Fibonacci retracement. For a Fibonacci retracement is basically a tool used to measure or spot potential reversal or retracement level. Let's say the market is buying again. We are still using a buy analysis for an example here. The Fibonacci retracement, you draw from the peak, which is this place. Let's say from this place, from the peak high to the peak low. It is as simple as that. So this is how you draw it basically. So this is it. You will see it matches exactly where we draw it, and this is just a random drawing. You feel me? It's a random drawing. Let me just use this to be 2. So if we delete it, you could see when price got there, you could see the price retraced or reversed back. You feel me? To know how to professionally use a Fibonacci retracement, we have so many levels. We have so many levels. You see the 0.3, 0. Whatever, but we're only interested in the 50%. 50%. Why are we interested in this 50%? Like the half of the move. We have two major levels in the market, basically, which are the premium level or zone. We have the premium zone and we also have the discounted zone. So what is the premium zone? The premium zone is, let's take for an example, if market is selling, and you draw, or okay, let's just use the buy. Let's just use this buy. Let's just use this buy. Let's draw the retracement, the Fibonacci retracement again. So this Fibonacci retracement we draw, yeah, you see this is the 50%, right? Let's say this is the 50, let's call this the 50, the 50%. So to cut the long story short, the discounted level is anywhere below the 50% of the Fibonacci retracement, and a premium level is anywhere above the 50% of the Fibonacci retracement. So in a buy trend, if the trend is buying, we are only interested in the discounted level, which is below the 50%. That's where we want to look for our entry or look for our reaction or whatever. And if the market is selling, we are only interested in the premium level anywhere above the 50%. That's the one we buy from. So now how do we use knowing how to spot liquidity and knowing how to use this Fibonacci retracement to look for trades? That's where we are going now. So this is it. Let's take for instance, now we have gotten to this place. How do we know that it is time for us to sell? Or how do we know that, okay, how do we know that it is time for us to sell and this is where to sell from? It is very, very important. We don't want to guess like a random retail trader who don't know where to enter or when to enter or where to set their stop loss. We are different. We want to do things differently as per we know how to use liquidity sweep and we know how to use the Fibonacci retracement tool. You feel me? So it is quite simple. We want to wait. This is where you want to learn. This is where you want to practice discipline. Learn to sit on your hands until anything you know or everything you know starts building up and becoming clearer and cleaner to you. You feel me? What that means is, let's take for instance when the market bought up to this level. When the market bought up to this level here, we can't actually see. It does not make any sense. But the fact that the price does not make any sense for us to just jump in because we know that, okay, this place this place is a potential sell level. It does not make any sense for us to just jump on the sell and start selling, not knowing if the market is just reacting off of that level and we still eventually break it. We need more confidence, we need more confirmation. That's how you become profitable. Learn to sit on your hands, be disciplined, and wait for confidence, strong confidence to tell you that, okay, the sentiment has changed from a buy to a sell or from a sell to a buy. You feel me? Now the market has gotten here. The fact that a price is reacting off of your level, you should be happy at first that, okay, you are doing things right. At whatever level you draw or the level you draw, the price got to that level and started reacting, maybe retraced off of that level, is a certain sign that your zone or your level is working. But it doesn't mean you want to sell immediately. You feel me? We need more conferences. So, and what are the conferences? The conference is just very simple. We are looking for liquidity sweep and we want to use our 50%. Now, how do we use our 50% here? Nothing. So as time goes on, the price began to print more candles. Here we could see this. If this market, you could see if this market had come here and created this high like this, let's say, and do something like this would have been a liquidity sweep for us, meaning money is sitting down around here. But the fact that market got here and the trade is not taking out this high, it means the market has not grabbed the liquidity there. So it is not time to enter yet. We still want to wait. Meanwhile, this is what differentiates us from the retail trader or from those who don't know how to use liquidity. You feel me? Because them, they would have entered from here because the price is printing red candle and extend their zone to about 15 or to whatever, anticipating that price shouldn't be able to get to this particular level. But it's not that they are sure that price wouldn't get it. They just give it some breathing space, just widen the space as per they don't know exact place to enter from and exact place to get out from or to put their stop loss. But some people, they will put their stop loss just right above here. And look at what happened. The market sold, and later came back to take them out. God bless you. This is where we want to be looking for our own entry because now we now have a liquidity sweep. Price has now grabbed the liquidity, has now grabbed some people's money. This is where we want to be looking for our own entry. What's the next thing we want to wait for? We want to wait for break of structure. I didn't mention this, but it is very important to wait for a structure break. This is one major sign that the trend is now shifting from a bullish sentiment to a bearish sentiment. You feel me? So what's that break of structure? We want to see price break this the particular high, the particular low that created this high, which is the swing. This is the swing. This is one swing here, and this is another swing. The particular low that created that high, we want to see price take it out. We want to see price take it out. If price does not take it out, it is risky. Now, once price take it out, what's the next thing? This is where we want to utilize our Fibonacci retracement. Just like I said, from the swing low to the swing high. What did I told you about using a Fibonacci retracement when the market is selling? We want to look for the premium level. And what's the premium level? Anywhere above the 50%. Anywhere above the 50%, which is this place. This place right here. This is the 50%. This is the 50%, and this is where we want to enter from. And our stop loss, we are very sure that we have gotten all our confluences, all our confirmation. Market shouldn't come back to this particular place. This is the difference between you that knows how to use liquidity and Fibonacci to a random retail trader who doesn't know all these things. Now, how do you get your exit? Your exit is simply just going for the extreme low as well, which is this place. Basically just extend your sell function. So you are basically just extend your sell function to that place, to this level, meaning you are selling from this zone. You are selling from this place. This is your entry and this is your exit. This is where you are targeting to come out from. It is as simple as that. Now, what differentiates you as someone that knows how to trade liquidity? What differentiates you from those who don't know how to use the liquidity? Let's take for an example, same people who sold from here, like this. They don't know the exact place to put their stop loss, but they just guess randomly that the market shouldn't be able to get to that place. Now they put their stop loss here, and same place, they are same exit. You guys both have same exit. Now look at your risk to reward ratio. Yes, I think my trade was about 5 hour. Yeah, my trade was about 5 hour. You can see, and you see it on the left side of the screen here, the before of the trade. This is the before, and this is the after of the trade. This is how it played out. So I'm not capping here. This is pure thing. This is what I do on and on, again and again, and it's very simple. Yeah. So what's the difference? Spot the difference. As per they don't know where the exact place to put their stop loss. You see how they extended it, how the stop loss is wide. Look at what they gained. They only gained 2 hours, like 2 hours, all those stress for just 2 hours. 2 hours is not small actually, it depends on the capital. But you both sell, right? Same sell, same buyers. You made 5%. Meanwhile, they only made 2%. So that is one. So this is just another major advantage of knowing how to trade liquidity. It gives you precise entry, it gives you precise exit, and it increases your risk to reward ratio. And also it helps you avoid unnecessary stop loss, because if you trust me, there are some people now who would have lost. Remember, there are some people who already lost their money here, because this high is where they placed their stop loss. But for you, you know that the market is definitely coming back there to grab those money. So we were not where when they were rushing to enter, happy that they are making money already when the market was selling. You were still sitting on your hand. You who laugh last, laugh longer. That's the game. So knowing just how to use this tool, the liquidity sweep and Fibonacci retracement, bro, you are good to go. You are definitely going to become profitable. So we have come to the end of this video. If you find any value in this video, make sure you smash the like button and subscribe to this YouTube channel. And if you want to trade with me for free, copy my trade for free, or keep learning things like this, you feel me, keep learning from my trades, you can join my free Telegram community. The link is in the description of this video. Just be there, click it. You see all our banks Telegram. You see all our banks community there. Thank you for watching. Thank you for being patient. I hope you find clarity, and I hope this sinks in and you don't forget it. I'll catch you guys on another video. Peace.